Hey traders, Steve here again from Option Alpha. Today's video I want to walk through managing ex-dividend assignment risk. So we're going to take a look at this SPY short call spread that is in the money, and we have SPY ex-dividend date is actually tomorrow, Friday, December 15th. Really quick, just to update you on that QQQ short call spread we were discussing during the last video. I went ahead and closed it this morning manually. I just went in, hit close, and set my final limit price to the spread width of $5, and I was able to get out of the trade. You can see it never hit our profit target. I had it set to automatically close 2 hours before expiration, but I mean this trade was so deep in the money. It was almost $30 in the money, right? So since we opened QQQ, it's been on this crazy relentless uptrend with the rest of the market for the most part. So it wasn't much to do about it. We had Fed Day yesterday, we had CPI Tuesday, so I hung on a little bit just to see if any of those potential market moving events came through with any sort of bearish news. They did not. Seems like the market took it as even more bullish. So it is what it is. We went ahead and just closed that trade this morning, took the max loss on it, but that's okay, right? We set up that max loss to be a price point that I was comfortable with taking, and that's how we want to set up our trades, right? Should a max loss occur, we have the probabilities to let us know the likelihood of that, but we know that it is always a possibility. And so it was closed at the max loss, so that's okay. It was a number that I am more than comfortable with. Now let's turn our attention to this SPY short call spread. So in case you didn't know, tomorrow SPY is going ex-dividend. So what does that mean? That means that if you're owning shares of SPY tomorrow, or at the end of the trading day today actually, you are eligible to receive that dividend. Now, they're projecting a dividend somewhere around $1.58 to $1.78. It looks like they're never really exact until they announce it on the day of. But we can use that information to help us manage this position if we need to do so, right? So here's what we're going to look at. Right now, I am short the 464 call that is expiring January 19th, right? So right now, we are roughly $9.27 in the money. So I want to go ahead and click on SPY. I want to look at that option chain and show you what to look at to determine if you should close this position before the end of the day. So first thing I want to do is I want to look at the long call. I just want to show you something really quick. So we're going to go out to that January 19th expiration. And that 464 call right now is worth somewhere between $12.41 and $12.79. Okay, so we know that we're only $9 and change in the money, yet that same option is worth over $12. So that is all the extrinsic value, right? The intrinsic value is simply the current price less the call strike price, which like I said is just over $9. But the option is still worth a lot more than that. So from that standpoint, I'm not too worried about being assigned, right, if there wasn't ex-dividend in play, because there's so much extrinsic value, it wouldn't make sense for that option holder to forfeit all of that extra money. If they wanted to get out of the trade, it would make more sense to just sell the call. But if we are going to look at it as it pertains to ex-dividend date, we actually want to pull up the put option chain. So remember, I have the 464 call strike. So what we want to do is go and look at the corresponding put strike to help inform our decision. So we can see right now, 464 right, is worth about $2.80. So that's an important piece of information to keep in mind. Remember, the ex-dividend is right around 160 to 180-ish. So what we're looking at as the short call holder is whether or not that put option is worth more or less than the ex-dividend. So if it's trading for more than the ex-dividend, we are not at nearly as high of a risk of assignment on ex-dividend day. Now, if it was less than, we would have a very high likelihood of being assigned at the end of the trading day. So why is that? Let's think about this mechanically, right? If I hold that 464 call option, and I know that if I exercise that call option today, I am eligible to receive that dividend payment, which means if I exercise today, I essentially own 100 shares per contract of SPY at $464. Now, I would get that ex-dividend, which would be paid out on the payment date in the future of, let's call it $1.60 at worst, right? So I'm guaranteeing I'm going to make $160 per option contract. Now, if this put option was worth less than $160, it would be advantageous for me to go ahead and exercise that option, right? So why is that? It's just a basic arbitrage situation. If I exercised and I owned 100 shares at 464, if I could turn around, and let's just assume, for example, that this put option was worth $100. I could turn around, buy that put option for $100, which guarantees me the ability to sell SPY at no worse than 464 on the expiration of January 19th, right? But if I'm collecting that ex-dividend of 160, I've essentially locked in a guaranteed profit of $60, right? Let's fast forward to January 19th. Let's assume SPY was trading at 460. Well, I could exercise my put option at that point, which cost me $100, but I still have that $160 ex-dividend that I've collected, right? So I've guaranteed $60. And then should SPY be anything above 464, it's just going to be a little bit better return. So as the short call option holder, the most important thing we want to do is go and look at the corresponding put option strike price for the expiration date of that short call that we're holding. Should that put option be worth less than the dividend amount, we're probably going to want to go ahead and close that position, because if you are holding short shares of that stock, you are eligible to pay the ex-dividend. You are required to pay that ex-dividend fee, which would be $160-ish per contract. So if you have some short SPY call spreads or call options out there, go ahead and take a look, double check, go look at that put option to see if you're at risk, and then you might want to close it out before the end of the day if there is ex-dividend assignment risk. Now, I've linked this article in the comments as well. We walk through it step by step so you can follow along a little bit easier. But I just wanted to give you a heads up. Since I don't seem to be at risk, I'm just going to leave that position open. Since we have 36 days till expiration, so we have plenty of time, we're going to let the trade play out. We'll also keep an eye on that XLE that we opened manually in Trade Ideas last week. We'll follow up on that next week as well. All right, have a great day. Happy trading. I'll see you soon.